Well, hello, folks. I'm L.A. Little, and this is your weekly TA Wrap. We take a look at these markets, and we do it from a neoclassical perspective. Each time we ask ourselves what happened last week, and what does it tell us about the coming one. I do this show every Sunday night, broadcast at or before 10 o'clock Eastern Time on YouTube. It's archived there under the channel L.A. Little. You can catch me there, any device, any place, any time. And if you like what you see, folks, and you enjoy what I do and what I provide, I would ask you to share it with a friend. I mean, there's a Facebook tag there on YouTube. You can push it to Twitter. There's any number of social medium devices or actually sites that you can push to spread the word. Because everything you do to help me actually helps you. It makes me a little bit more effective, efficient, a little bit more profitable, and allows me to spend even more time and hire more resources. So anything I do that really does tweak your interest, I think I do a pretty good job at what I do. I would appreciate you helping me to spread the word. As far as these markets, well, folks, we had the breakdown, and we started talking about it. Last week was a tough week because we had a lot of gyrations. But by the end of the week, it was pretty clear what was going on. It was down, and it was down hard, and it just kept going down. Our big tell has been this Russell. The Russell index has been our best tell over and over again. 9.5% on the year now, negative, almost 5% on the week. NASDAQ started chipping in 4.5% on the week. You can see the numbers. You're barely positive now on the S&P and the NASDAQ. You've gone negative on the Dow now. A very different story than we've seen for a very long time. So that negative sentiment that we were looking at, that we were expecting at some point to kick in, did in fact kick in. It kicked in hard, and fortunately, we were looking at it from the right perspective, I do believe, and hopefully you sidestep most of that as we did. Let's look at the markets. Let's see what we got here. Let's think about what's coming. We'll start with the S&P as we usually do. S&P is right at that swing point low, only a couple points off of it on the daily chart. 1904.78 was the close down there. You got the 1906.13 on the close, down 1.15 ticks. Volume expands as we come down there. Folks, this is going to test it tomorrow, probably break it. And that's a little bit more negative than I was originally thinking. I thought we'd get some sort of a push down into potentially into this area, and then we'd get a bounce from there, because that was the actually it was from here. That was the ABCD structure that completed down into that area. But this is a negative setup on all of these markets now, and whether we're going to blow it out here or whether we're going to get that bounce first before we do some more damage really is kind of the question. We'll try to answer that as we go along here. If we look at the weekly on the S&Ps, that same swing point low is the swing point low on the weekly. And as you can see, we're coming into it with slightly less volume, 162 on the week prior, 158 on this one. How we get under that, if we do, and if we stay under that, that's going to be the next tell. You can see on the weekly, that is where support lies. So S&P's fairly negative, right at a critical point in the fact that this area is a trend transition on the intermediate term time frame if it breaks. Dow Jones gets under the swing point low, does it with volume, transitions trend. Now this is on the short term time frame. Transitions trend to bearish. So we got a bearish trend here. S&P, as we saw, not quite there yet. If you look at this on a weekly time frame, it's coming down towards its swing point low. The second attempt to get into and under the retest regen is here. You can see the support on the charts there. This one doesn't look quite as bad, but volume expanding as we're coming down. Where it is bad is not just the Russell, but now it's on the NASDAQ composite itself. NASDAQ goes bearish on the daily, and transitions on the weekly as well. Here's that swing point low. It went under it. Volume expands tremendously, blows it away, right? It's up underneath it. Now this all becomes resistance on any kind of a bounce. And what we're going to have to start looking at next is what does the retest regen zones look like on these various charts. For example, on this daily chart, it's here. And lo and behold, just as you would expect, the top of that retest regenerate, that bearish retest regenerate, is the top of this high. You know, this breaks high. That's where all the volume is. That's going to be hard to get back over on the way back up. That sets up a pretty hefty resistance zone. And I suspect these markets are going to continue to struggle and trade lower even into earnings season now. That certainly looks to be the setup on these markets. If we pop over here to the weekly time frame, swing point low gets underneath it. This is what I was talking about. Volume expands, transitions trend. You can see it's coming right into the first of 3 support zones. We show 3 on the TA Today charts. The top one is up here, is a little bit weaker. The stronger one here is in the middle. And then you get some real strength down here if you were to actually crash and burn, so to speak. But if we look at this, it's fairly evident now. You've got 2 kind of equidistant ranges. I didn't quite draw that correctly, but it's almost there. A little bit farther down. This just barely budged into the second of the lower ones. If I were to try to redraw this a little bit better, let me see if I can get it here. This would actually come down just slightly more. And then, of course, this one would be the same, down a little bit farther. And that would give you kind of the equidistant. And you can see it's just inside of it. So we come down. We're breaking into the lower range now. Right? We're just at the edge, just starting to break into it. If it holds down here, and I think there's a pretty good chance over the next couple of weeks that it does, then the target becomes the lows of that range. That would be a range trade breakout to the downside, and that's what you'd be looking at from that perspective. Now, you know, recognize we're on the weekly chart here. A lot can happen in terms of days, you know, daily charts, and the weekly charts still continue to push down. So don't expect this thing to just go straight down and, you know, without any kind of revival to the upside. And I was just glancing at the monthly, really nothing here. You got big volume on that bar, it's at 41.77. So, you know, as we come down, it will be all about how we finally get a bounce when we get a bounce. Here's the NDX. Hasn't gotten to the swing point low, but it's into it now. Volume expanding. It looks like it's going to try to test that swing point low before it's done. This has been the strongest index. This is the one that when we finally get the bounce, it should be the one that tries to turn. 38.45.20 is that low. We closed at 38.70, so we're only about 35 points away. And given the way this thing's moving, 35 points is nothing anymore. That's on the daily. If we look at it on the weekly, you're coming after that swing point low. That low's 38.37.16. So again, not that far away, and you're coming at it with volume. Now, one thing that hasn't, you know, the only index that really hasn't came back in yet, and you can see it here when you look at the bullish retest regenerate zone, is that the NDX itself, right, that bullish retest regen zone is off the prior high that has not been tested. And that prior high price point there is 37.38. Again, we're at 38.70. So you can see another 135 points just to get down to the retest regenerate zone. I suspect before this is all over, we will probably be down there. If we draw that range again, just as we did on the other, on the NASDAQ, that's going to take us down. Yeah, it's probably not the best range. I'm trying to see where the best range is. Actually, it was probably up here. You got one there, another one into this one, and then the one below it. So something like that. So anyway, we're coming into that lower one. We're going after that swing point low. The the Russell. The Russell has all year long been telling us something was wrong, and that something, dynamically was wrong, not just small way, but big way. This is down almost 10%, and we're still positive on the NASDAQ and on the S&P 500. That's how divergent this has become. Now, I know, and others will say that, we ran higher last year. Yeah, I mean, last year was some sort of an aberration itself. Russell was up about 37. The Dow was up 27 or 28 or whatever it was. So, yeah, it did outrun it. Now it's coming back. But, when you get something that's this divergent, you show this weakness, and this one is the one that keeps leading, that tells you there's an issue, and at some point it has to resolve, and you're starting to resolve to the downside. But even now, you're still not closing that gap. Russell blows away the lows, gets lower, does it with expanding volume. If we look at it on the weekly, this is the key tell, and that key tell is all these swing point lows have been broken now. 5 of them, folks. That doesn't happen very often. All 5 broken. That says this range now is all distribution, and that anybody that bought over the last year is losing. What does that also tell you? That tells you any push back into this retest regenerate zone, which is here, is going to be an invitation to sell. And so you have to expect any kind of push back up is going to be an invitation to sell. What does that mean? That means that when this does start bouncing, let's just assume it bounced right from here. When it does start bouncing, it's going to set up another ABCD structure to the downside. And if that's true, what really becomes an issue is now the Russell, and I'm looking on the monthly chart now, and we haven't looked at a monthly chart in I don't know how long. That says that this range that was there, if you expand that range down about an equidistant zone, you can see this swing point low is nestled right up underneath where that range trade breakout is going to take this market. That's about where that zone, that lower low, right, this swing point low is. The lower part of the zone is just above it, about 5-10 points above it. If we do push our way down to this bottom, folks, that's going to put the monthly in jeopardy. We haven't seen a trend change on the monthly since 2008. That's significant if we see this truly take place. And we're setting up the structure to do that. Now, you have to recognize that, we're talking about a monthly time frame. So for something like this on this time frame to take place, you're going to have to get time, right? It's going to take more time to do this, and it's going to take a few months. If you go back, and I've said this many times, if you go back and look at 2008, and even if you go back and look at other periods where markets topped and then eventually crashed, it takes time. It just does not happen right away. Everybody's impression is that crashes just come out of the blue and boom, right? You crash. It's not the way it works. It takes anywhere from 6 months to a year and a half for these things to develop and actually crash, if that's what they're going to do. But you had this same scenario that we have exactly right now back in 2011, and we did not crash, right? That was this time frame back here. Yes, big correction, but no crash. Didn't happen. Why is that? Well, because when it got down there, it just ran out of sellers. Here's the swing point low. You can see just how we were just talking about it up here. Swing point low here. Range trade takes us to about there, right? Same sort of thing was happening back here. You had a break of a range trade there. If you project it lower and then you project it lower one more time, let me get that last one off there and let's do it one more time. So if we project it one more time, you're going to see that it projects right down into where it went. Right? Took 3 down. This one's only 2 down to get there. But that did not break in the end, and that led to another huge rally. There's nothing to say this one won't do the same thing. So when you look at it from that perspective, right, you can realize that we're in that transition period where it's not clear that we're going to get the crash, But it looks pretty clear we are going to get a significant sell-off. It's already underway. I suspect it's going to continue. So in summary, and although my summary's a little late, it's taking me 10-15 minutes here to get to it. In summary, I believe that is what you have to expect to come over the next few weeks, maybe months. All right, so let's switch over to another set of ideas. Oh, one last thing while we're here. That transition, you can see it's just gone bearish here. These were at extreme values, and these are the MTTFs. And when I'm talking about extreme values, here's a 97 and a 91 on the S&P 500. This is the cumulative probability that trend is going to fail on this time frame for this instrument. That's a huge number. That just doesn't happen very often. It's a testament to the ability of the Fed to manipulate these markets, which is what has happened. And here's 91 on the NASDAQ. If I look at the NDX, you're going to see it being extreme as well, 95, 90. So this stretch higher is not normal. Of course, nothing's been normal for 4 years. So I guess it shouldn't surprise us that this isn't normal. But folks, you can't manufacture growth. You can set up the conditions, but unless there's the confidence and the expectations that one can create more plant capital, expend capital and create more plant materials and create more goods as a result, and people will be there to buy them, then people aren't going to build new factories and they're not going to expand productive capacity. There's no reason to. I don't care how cheap money is. Unless you see a reason to, you're not going to do it. And that's only common sense. If I'm a businessman, sure, the math works, but if I can't look at that demand side of it and say there's going to be increased demand, why should I produce more widgets? There's no reason to. And that's where we're at. And the Fed has tried to force that to happen by forcing more risk. People ain't buying it. Businessmen aren't buying it. They're doing what they always do. They're taking advantage of what you give them. What is that? Well, they're taking that cheap 0% interest rate, that equates to 1.5% for them. They're issuing bonds. They're taking and buying back their stock. They're reducing the amount of stock that they have out there, so their earnings per share goes up. That's how they're manufacturing their financial, profits. That's why the market goes up. Probably 60-70% of the gains have been that way, because if you go back and look at it, you have not seen sales gains on any magnitude that we've seen in most recoveries. Sales are not increasing across the board. Sure, there's some companies that are able to do it, but most can't. And so they have to manufacture those earnings to support these higher stock prices. It's pure and simple. There's nothing else. There's no other way to look about it, right? It just doesn't. You can argue anything you want, especially on a fundamental standpoint. But what really matters is what the money does. And when I see the money crashing and burning like it is now, I'm not going to stand there and try to catch it. And you shouldn't either. Let's move to the sectors here. Actually, before we go to the sectors, I want to show you one other thing, and that is that one of the ways I look at risk in the market is through junk bonds. And when I look at the junk bonds, they're breaking down here. If I look at them on a weekly time frame, they've broken down as well. And if I look at them on a monthly time frame, they're also starting to break there. They've broken a swing point low. They're sideways. Now, mind you, this is a long way to go to get back down here. But it does look to me like they're going to go after this swing point low. And, that is another risk factor telling us that we've probably got some issues out here. Let's go over to the sectors, because I want to show you a couple things on the sectors. And then I've got a few questions I need to jump on those for some members that have, some viewers that have asked questions. So let's pop into sectors. If you go back and look at the sectors, and you go back and look at 2007, 2008, you know, the real estate sector was the first one that started to crumble. That was in, I think it was in March of 2000. I actually have it available. Let me grab it real quick and see. Trend transitions, and if I look back in 2007 on the monthly, no, on the intermediate term time frame, that was in, bear with me as I look it up here. And it's taking me a little while. So as I grab, here we go. IYR, that was 5/14 of 2007. And you actually had the KRE, which was the insurance, I believe, if I remember right. No, KRE was the regional banks, I believe. Those went in March of 2007. So in March 2007, May 2007, and then the XHAB, which is also real estate related, that one went in June of 2007. Those were the ones that were leading up to what eventually became the crash, right? But they were the early warning signals. Well, the XLE this time around is that early warning signal. You can see the damage here on the daily. Let's go to the weekly though. Here's two swing point lows. It's coming at them, and it's coming at them with huge volume. A break of these swing point lows is not only going to break multiple swing point lows and multiple swing point lows on the daily, those are dailies as well, also weeklies, but the monthly. This will be the first index to do it, or the first sector to do it if it happens. Breaking all of those is a huge deal. Now, that would be the first one to go bearish on the intermediate term time frame, to transition on the monthly time frame to sideways. And that still doesn't mean that we're going to have any crash or anything like that. But it definitely means we have trouble, and it's going to take a while for this to work its way out. And if we take that same idea and say, okay, are there other sectors? Because as you know, once you get two or three of them, most all of them are going to follow. And if you look, there's a couple others that aren't that far away. Here's the XLI. You can see that swing point low there. Not that far away from the current price. We're talking within 5%. That's certainly doable. And if I pop over and I look at the weekly on the XLY, you already got the break here, not the weekly, the monthly, I'm sorry. The monthly on the XLY, you can see that price point there. Again, you're about 5% away. If you start breaking multiple sectors down on the monthly, that's a problem. And so these are going to be key things to be watching this month, next month, to see if they actually get down there and start breaking or not. Again, it takes time for these things to develop, so it's going to take a while for these to develop. And if they do break even this month or next, that doesn't mean it's just going to go straight down from there. It's going to take a while, right? It's just going to be laying the groundwork for something even larger to take place. That's why you watch these things, okay? So that was just another thing. Now, we also have, a lot of issues on world markets with that big run up in the dollar. They're starting to show the same sort of wear and tear. So there's just a lot of things out there that are telling us there's a lot of issues out here, and we need to be aware of that. All right, so let's pop over. I want to give you, or I want to answer some member questions, some viewer questions. Let's see what they got here. So one of them is TRN, and let me type these in as I go and see what we have on these. thought there was another one here. Yeah, I'm pretty sure there was. Oops, excuse me. Let me see. Let me start with TRN and then we'll go look at the other ones. Because I'm pretty sure there's another question. I just need to find it. Okay, so TRN, Trinity Industries. Question here is the TA today charts look like a stop loss of 33 is called for on the stock has been diving. All right, so let's pop this over to a weekly and see what the weekly looks like. Yeah, actually you've already got a lot of trouble, and had I been trading this, I probably would have put my stops up underneath this multiple swing points, because you know, with these multiple swing points here, if they start to break, then you're usually going to get a faster move down, and as you can see, that's kind of what happened here, right? These two swing point lows, the lowest one here being on what is this, 39.52, 39.52, and now we're sitting there at 35, 34 something. So you can see how that has put a fast move down, volume expanding, all of that. And if you look at it here with that low, 39.52, now we're at 35.17. You've already dropped more than 10% in a week off that break. So, you know, really they should have been up there initially. I suspect you would have seen support up in that area initially, and those two swing point breaks. You never want to try to stick around when you start getting breaks on multiple time frames. So a break, you know, if I pop back over here to the daily, you can see the break here on that swing point low. That was at 41.05. And if I go back now to the weekly, 41.05 was probably this guy, and it was. So that was your first indication that you had problems, that you could get a faster escalation. So that would have been where I put the stops. Now, to answer your question now, you know, your last bar of significance has a top here at 34.10. That swing point low there is 33.43. What I would do is I'd probably have my stop somewhere around what you're saying at this point. Let me pull up one other item here, and that is go back to this. Pull up the tools, get up the trading cube, and let's look it up here because I want to see what the ATR is on this guy. So if I look at the ATR on the weekly time frame, that's pretty high, 405. So that's really a buck. And even here, if you're doing it on a daily, that's like 60 cents that you have to give it. So if I go back now to the chart, you know, if I use this on a weekly and give it a buck, that's 34.10. Yeah, it's about 33. So I'd probably put my stop around 33.03, 33.05 or something. I never put it on a round number, you know, like 33. So that's where I'd put it. And yeah, and you know, there's a chance that it hit it because it's coming down pretty hard and pretty fast. Let's look at the other one here. Let me see what it was. Let me see. Question was, nah, don't have it. Okay, well, I apologize because I just don't see it here. I'm almost certain there was another question asked, but I just don't see it. So I guess I'm gonna have to skip it. I'm about out of time here. I'm gonna have to leave it at that. If I did miss your question, I will pick it up tomorrow for you, and my apologies in advance. Folks, it's gonna be a tough week. I do expect bounces. The markets don't go straight down. They don't go straight up. There's something in between always. But you've got some damaging situations set up here. If they start breaking, I suspect we could get anywhere from another, 1 to 2, maybe even 3%. So it's going to be a tough road down. Got Could get a bounce at any time. Matter of fact, the thing that could cause the bounce at any time is the Fed. You know, I've already seen articles this weekend where, you know, the Fed officials are saying, oh, the global slowdown could push back the hike, the U.S. hike, you know, on rates. There was another one about the dollar strength could do it, right? All the little minions from Fedville are going to come out and start telling us that that rate hike that they've been telling us about maybe not going to happen. And you can get a spike out of it at some point as a result. Have yourself a great night. Thanks for joining me. Tell a friend, tell two. I'm LA. This is and it was your weekly NeoTA wrap. Have a great one, folks. I'll see you tomorrow. Good night.